all about really narrowing the range of outcomes right now, really focusing on certainty over uncertainty. And that's really what buffers provide. It's obviously a trade-off here. The strategies that you just mentioned with a 15% buffer, you take an example like PJAN. Over the course of the full calendar year, investors can know that if the market goes down anywhere from 0 to 15%, they're going to be protected against those losses. They would take on any losses beyond that 15% mark. And then on the upside, they would be able to capitalize on the S&P 500 ETF return up to the first roughly 12% of gains. So it's really for those investors that don't want to take on the full risk of the equity market, but still want to generate equity-like returns in their portfolio. So the trade-off comes in the form of a cap, and there's many different buffered ETFs in the marketplace. This is a category that has exploded to about $50 billion plus in the US. And there's really, the cap is all dependent on the level of protection that you're getting. So the 15% buffer, which has been the most popular in the US, those caps are right around 12 to 13% right now. Innovator also offers strategies that have 100% buffer. So really principal protection outside of the expense ratio. Those caps over a 1 year period are in the 7 to 8% range. So it really allows investors to pick and choose what is their risk profile, how much upside do they want to forego, knowing that if the market does fall, this is the level of downside protection that they have in place. There's always a cost to protection. And if you're an investor that has a 30-year time horizon, grabbing and holding a low-cost S&P 500 strategy is a great way to go about it. But really what we see with these strategies are a couple different applications. One, they're very heavily utilized in the retiree, pre-retiree community, where those investors, they don't have that time horizon. They can't stomach the full loss of the equity market. And instead of taking their portfolio from a 60-40, maybe down to a 30 stock, 70 bond mix, these funds really allow them to maintain their equity exposure, maintain that growth tilt, while still making sure that they're in full control of the risk that they're taking on in the portfolio.